Welcome back, traders. We've covered setups and entries. Now, let's focus on critical trade management. Today, we'll explore holding, scaling, and exiting positions effectively, which are key aspects of trade management. Many traders obsess over entries, but true success often hinges on what happens after the entry, not just the perfect start. Consistent profitability comes from superior trade management, not merely from identifying good setups. Two traders with the same setup and entry can have vastly different outcomes based solely on their trade management. We'll cover essential strategies, scaling in and out, taking partial profits, adjusting stop losses, and knowing when to hold or exit. By the end, you'll have an actionable daily playbook for effective risk control and consistent profit locking. Let's begin by diving into the nuances of scaling, a technique often misunderstood by many traders. Scaling must be rule-based and directly tied to your established trade setups, not impulsive decisions. When scaling in, only add size if the trade actively proves itself, confirming your initial thesis. This includes a higher low, a successful retest of a key level, or a significant increase in trading volume. Market alignment, where broader conditions support your trade, is also a valid reason to scale in. Four-phase setups like a breakout followed by a retest, scaling in after confirmation is a sound strategy. Crucially, never scale into a position due to FOMO or to fix a losing trade. These emotional decisions often lead to increased risk and larger losses, undermining your management plan. Scaling out is about locking in profits without prematurely killing a potentially larger trend. Scale out after hitting your first risk-to-reward target or when new market structure forms. The 50/25/25 rule involves taking 50% at the first target, 25% at the second, and trailing the last 25%. Other strategies include quarter scaling at new highs, momentum exhaustion, or level-to-level profit taking at prior highs, Fibonacci levels, or VWAP. The key is to be consistent and objective in your scaling decisions, removing emotion. Taking partial profits is a powerful technique to reduce risk and build confidence. Consider taking partial profits at major price levels like pre-market highs, daily highs, or VWAP. Reaching specific R multiples, like 1R or 2R, is another effective trigger for partial profits. Slowing momentum or a parabolic surge in price can signal an opportune moment to take profits. Significant changes in the broader market, such as in SPY reversal, also warrant partial profit taking. If your stock breaks out to a prior high, take 25 to 50% profit, then move your stop loss to break even. This secures profit and eliminates risk, allowing the remaining trade to ride for larger moves without stress. Adjusting your stop loss protects capital, but only as new market structure forms logically. Move your stop to break even once your first profit target is hit, removing all initial risk. Trail your stop below higher lows in an uptrend, above lower highs in a downtrend, or beneath trend lines. For dynamic stops, consider volatility-based adjustments using indicators like average true range, or ATR. However, there are critical nevers for stop-loss adjustments that you must strictly adhere to. Never move your stop further away hoping for a reversal. This significantly increases potential losses. Never remove your stop entirely, as this exposes your capital to unlimited risk, which is unacceptable. Avoid adjusting your stop out of fear or trailing it too tightly, leading to premature stop-outs. Stops should only move when the trade is in your favor and risk can be logically reduced based on price action. Now, for your assignment to solidify these concepts and integrate them into your trading routine. First, write down your specific scaling and stop-loss adjustment rules for each of your primary trade setups. Next, apply these rules to at least 10 historical charts, identifying how you would have managed those trades. Finally, for the next 10 trading days, commit to following these rules 100% in your live trading. Focus entirely on your behavior and adherence to the rules, not on green days or red days. This behavioral focus is paramount for developing consistent, disciplined trade management. In our next video, we'll delve into journaling your trades, a powerful tool for continuous improvement. Great work today, and remember, consistent management leads to consistent profits.